Most people are looking at the market's response to the Trump victory, which I suggest is mostly a whole bunch of to-do about nothing. I'm much longer oriented. And as always, I'm trying to figure out what's cheap and what's not cheap. And among those things that are cheap, I look at the broad landscape as an example in the United States market. And despite the fact that I'm starting one, I think community banks are really, really, really cheap. People are pricing them as though other folks won't need banking services for the next 30 years, which is absolutely stupid. I think that there's a lot of indecision around the good, the bad, and the ugly among the uranium stocks, and people tend to value them the same, although there's vast differences between the companies. So I'm trying to take advantage of that. When I look at the investment landscape going forward, of course, all things change. But I'm struck by the similarities between the circumstances that confront us now and the circumstances that confronted an earlier generation in the decade of the 1970s. Incipient inflation and the lack of understanding about the way inflation impacts the purchasing power of one's savings, and the potential both to decimate the long bond market, decimate savings, and reward those investors who participate in alternatives. I've owned those two stocks for a very, very long time. They're certainly cyclical stocks. If one owns them through the cycle, which I do, they perform extraordinarily well. In addition to that, people knock them because they're slow-growing industries, but they are both companies that have been reasonably successful at vertical integration, which is unusual, and they are companies that generally have, within a band, decent returns on capital employed, and because they're slow-growing, they're usually kind enough to return a fair bit of their income to shareholders by way of dividends, and those are in fact earned dividends. Investors in the space need to be very concerned about the outcome of a peaceful resolution in the dispute between Russia and the Ukraine. When the Russians come back into the phosphate market, they are the world's largest, world's lowest cost producer. For a while, that's not going to be a problem because the Russians have deferred sustaining capital investments. It seems the Russians have had other uses for money. And if you defer sustaining capital investments, you impair your ability to produce in the out years. We saw Russian potash industry take 5 years to recover from the reorganization of Russia in 1989, 1990, 1991, the last time that the Russian state needed money to the extent that it needs it today. So, assuming, first of all, that peace occurs in the Ukraine, which I hope happens, there will be a time when the Russians and their friends, the Belarusians, retool their domestic industry, which will give the West some breathing room. When they retool in the potash industry, you need to understand that Russia can be the lowest cost and highest volume producer on the planet. That would be my only caution. I think, too, that 5 years from now, the price of all nitrogenous components goes up. Natural gas is too cheap right now. It's produced as a byproduct of oil. The consequence of various technologies coming together with a very low cost of capital has meant that U.S. oil production in particular, but Canadian oil production too, has surged, and byproduct gas production has surged. The BTU arbitrage between oil and gas is too high, and billions of dollars are being spent on monetizing that arbitrage. Over 5 years, that'll be successful, but it won't be successful in 2024, 2025, 2026. The bottom line of that is that natural gas prices will rise. The consequence of that is that nitrogenous fertilizer prices will rise, and that will impact all the way down to the farmer. He or she will have to pay more for nutrients, but the nutrient distributing companies will have to pay more for that input. Buffett famously says, put all your eggs in one basket and watch that basket very closely. The truth is that Nevada's premium royalty is Northern Nevada. That doesn't suggest, by the way, that there aren't real political risks in the United States, but that's a very different question. What Franco-Nevada has managed to do mostly is concentrate on very, very high-quality assets. They have come down the quality trail because they've been impatient. When the ability to attract high-quality assets gets scarce, the temptation is to do something. With regards to both Franco and Wheaton, what attracts me about them is that we are in a new era of mine finance, particularly in the copper space. And building a copper mine with gold and silver byproduct credits is an extremely expensive endeavor. If you are having to raise $8 billion, as an example, you need to utilize all aspects of the credit stack. Gold or silver cash flow in a copper producer is valued at 6 times EBIT. That same cash flow, limited to gold or silver as a stream or a royalty in a precious metals company like Wheaton or Franco, is valued at 15 times EBIT. That's too great an arbitrage to ignore. This new cycle of mine finance, and separately a cycle where sovereign governments in emerging markets want increasing equity shares in mines but can't pay for them, and could could pay for them through the sale of a royalty or a stream to somebody like Franco or Wheaton means that the companies with the financial means in the next 5 to 10 years are going to have the opportunity to deploy billions of dollars in tier one deposits that will generate free cash for 20 or 30 years. The knock on both Franco and Wheaton is how do they grow? And the answer's right there in the market. The arbitrage between precious metals cash flows trapped in base metals producers or crystallized in a stream on behalf of a royalty and streamer is the difference between 5 or 6 times EBIT and 15 or 20 times EBIT. It's entirely a function of how hard that investor wants to work and what their tolerance for loss is. Jesse, at the beginning of my investment career, I was insanely speculative. But let's put that in context. I was co-owner of the most popular bar in Vancouver, a bar that was frequented by Murray Pezim, Adolph Lundin, Billy Rand, Peter Brown. And I literally, not figuratively, would pour these guys drinks and ask them questions. Run back in the back, write down the answers, come back, pour them more drinks, ask them more questions. I worked very hard. I had great access to information. I was present at tables where deals and transactions were taking place. Not that I traded on material, non-public information, of course. Suffice it to say, I had a definable competitive advantage and I worked very hard. And because I owned that bar and I had dependable free cash flow, and because I had invested in a couple of triplexes where my cost of capital was fixed, but my return on capital employed continued to increase, I could afford to be extremely aggressive. All of the money that I now invest carefully, I made by speculating wildly. But I worked hard. I had advantages. Somebody who lives in Vancouver, somebody who is willing to go up to Ross Beatty when he's at Tim Horton and ask him a question over coffee, someone who reads insider reports, who reads resource calculations, who reads PEAs, that person should be aggressive. A smart, hardworking person who knows the difference between volatility, cyclicality, and risk, who lives in Vancouver, who can participate in private placements. There's just no excuse for that person to make $1 million in the next 5 years. But remember all of the classifications, all the categories. That same person, if he or she lives in Omaha and isn't willing to work hard, that person needs to be involved in beta, not alpha. I know a lot about natural resources, and I know a lot about conventional financial services, insurance businesses, banking businesses, agency businesses, and I don't know very much about anything else. I have no idea if tech stocks are overvalued. I don't know how to do net present value calculations on businesses that are growing quickly but don't make any money. I don't know how to analyze consumer durable businesses or entertainment businesses. I believe that the cost of capital will go up. I believe that the market would like to take interest rates higher, although the big thinkers would like to take it lower. So I'm cautious. And I take Buffett at his word. Buffett said he wasn't building cash as a tactic. He was building cash because some of the businesses in his portfolio were, by his measure, overvalued or fairly valued, and he couldn't find other places to put the money. He sees himself as being opportunity constrained. Now, that may be a market call. I mean, yes, he's invested what for him is pocket change, $250 million in Domino's Pizza. But pretty obviously, when you're coming off, I don't know, $100 billion worth of sales of Bank of America or Apple, you can't put all that money in Domino's. I think he is finding a difficulty in investing in companies with some sort of moat that have good margins, that are big enough for him to participate in. It's interesting when I look at his criterion, the industry that stands out to me, which is to say the oil and gas industry. It may be that I'm falling for my own bias in that I'm attracted to the oil and gas industry. It may be that there's something in the out years that he sees in the oil and gas industry that I don't. When I look at intelligent balance sheets, high margins, return on capital employed, I notice that the industry as a whole is not making sustaining capital investments, which is problematic. If you don't invest cash flow now, your means to generate cash flow in the future gets constrained. But there are companies in the sector that are making the sustaining capital investments and the new project investments while simultaneously rewarding shareholders.